Hello friends, let's discuss about IFRS Profit and Loss statement today. Hi, my name is Pratish and welcome to Deep Dive into IFRS. When it comes to Profit and Loss statement, there are two basic differences between Ind AS and IFRS. While Ind AS asks you to list out the expenses nature-wise, IFRS gives you an option to choose either nature-wise classification or function-wise classification. If you are listing out the expenses like rent, travel expenses, salary expenses, etc., that is called nature-wise classification. But if you are listing it out like administration expenses, if you are grouping the expenses under administration expenses, selling and distribution expenses, marketing expenses, etc., that is called function-wise classification. Only IFRS gives you the option to choose. The second difference is that under Ind AS, the profit and loss account statement has to be one statement comprising of two sections. The first one being the profit and loss section and the second one being the OCI or other comprehensive income section. When it comes to IFRS, you can either give it as a single statement having two different sections, that is P&L and OCI, or it can be two different statements, one P&L statement and the second statement being the OCI statement. The concept of extraordinary items is not recognized under IFRS. According to IFRS, all the events and transactions happening during the year are part of the business and hence ordinary and not extraordinary. However, exceptional items are recognized under IFRS. Now let's look at the minimum line items that have to be shown on the face of the profit and loss account. Revenue from operations, finance cost, tax expense, impairment losses, few items relating to IFRS 9 like reclassification of financial assets, few items relating to IFRS 17 like income and expenses attributable to reinsurance contracts and insurance contracts, restructuring cost, impairment to inventory, gain or loss on disposal of intangible assets, gain or loss on disposal of property, plant and equipment, profit or loss from discontinued operations, profit or loss for the period split into profit or loss attributable to the non-controlling interests and profit or loss attributable to the owners of the parent. There are a couple of points to be noted here. The above list is the minimum number of line items that have to be shown in the profit and loss account. But if in addition to this, as per the provisions of an IFRS, an extra item is required to be shown in the profit and loss account, that is allowed. Also, the second point is profit or loss from discontinued operations has to be a single line item only. You can't give subdivisions to that. But other than that, there is no such restriction to any other item. In fact, in some circumstances, giving a single line item will not convey the full information to the users. So in such cases, you can give subdivisions and sublevels and subtotals as well. Let's go to the OCI section now. Now, in contrast to the P&L section, the standard specifically lists out what could be shown under OCI. Only these and these alone could be brought under OCI. Now, these could be as a result of the management decision or otherwise. Regardless, these are the only items that should be present. Number 1, changes in revaluation surplus. Number 2, actuarial gains or losses or remeasurements in defined benefit plans. Number 3, gains or loss on investments in equity instruments designated as FVT OCI asset. Number 4, gains or losses in financial assets designated as FVT OCI asset. Number 5, gains or losses on translation of financial statements of foreign operations. Number 6, effective portion of gains or losses of hedging instrument in a cash flow hedge and gains or losses of hedging instruments that hedge investments in foreign operations. Number 7, for specific liabilities classified as FVT P&L liabilities, the change in the fair value of the liability attributable to the change in the entity's own credit risk. Number 8, changes in the value of the time value of options while separating the time value and intrinsic value of an options contract and designating as the hedging instrument only the changes in the intrinsic value. Number 9, changes in the value of the forward element of a forward contract while separating the forward element and spot element of the contract and designating as hedging instrument only the changes in the spot element. Now, the above items might have been too technical or too complicated for some of you guys. When I'm discussing the relevant standards dealing with them, I'll try to explain them in a manner as simple as possible. Now, if you might have noticed, the OCI is more like a reserves account made up of unrealized gains and losses. When some of these are realized, they can be moved to the profit and loss section. The standard specifically tells that only items dealing with 4, 5 and 6, only those unrealized gains or losses when realized can be moved to the profit and loss section, not the other 6. I hope this video was useful to you guys. Till I see you in my next video, thank you for your valuable time.